Joining us now to discuss, Franklin Templeton, Sonal Desai, Jim Bianco of Bianco Research. Great to catch up with you both going into the opening bout, going into a busy trading week. Sonal, I've got to start with you. A lack of clarity from the ECB, a lack of clarity from the Federal Reserve, a lack of clarity from the BOJ. Some people might say it's by design. Is it a good thing?
It's a good thing. Maybe it's time for markets to stop looking to try and anticipate different central banks' next moves and start focusing more on the data. Look, Jonathan, we've had an enormous number of hikes and the economy keeps chugging along. I think this is not pointing towards an economy under threat from central bank hikes, as everyone anticipated. It is an economy which needs to get used, and a market which needs to get used to a new level of central bank rates, which is substantially higher than where we were for the last 15 years, say.
Jim, is the hand-holding over?
I think it is over, and it should be over. I think that part of what you're seeing with this strategic ambiguity with central banks is a bit political. And what I mean is there's no agreement within the boardrooms of these central banks about what they should do next, even though the Fed wants you to believe this with 11-0 votes. And ultimately, they're trying to figure out what their next move is going to be. And I think it comes down to inflation. Is the inflation rate bottoming this summer, and is it going to start up? Or is the inflation rate going to continue to head lower? And that will probably be the main driver of what comes next.
Well, Jim, we know what you think. You think it picks back up, don't you?
Yeah, I do. I think that we're at the low on a year-over-year basis now, and it's the base effect. If you look at last July, it was 0, was the inflation rate, was 0.2 in August. With just the jump in gasoline prices in the last week or two, we should easily jump over that. We should be looking at 3.4, 3.5 on the year-over-year inflation rate by, say, Labor Day, if not into October, and that should be enough to at least get the Fed to consider more rate hikes.
So now, where are you on that? The prospect of inflation picking back up later this year?
I think I actually have a lot of sympathy with that view on headline rates, but what I will say is I just don't see core inflation coming substantially below, say, 4.5% as we get to year end. And that's why I actually think additional Fed rate hikes are definitely still on the table. I don't think we can rule it out.
Is there any evidence, Sonal, from your perspective, that we are sufficiently restrictive? When you hear the Fed chair talk about getting to restrictive levels and keeping those rates there for longer, do you even think they're there yet?
Honestly, I would argue it's not so clear. Look, for right up to the pandemic, if we look at that entire period, we've had real rates of about 0.5%, and there's a lot of people who believe that neutral Fed funds rate, nominal rate, is around 2.5%. So a 0.5% real rate if inflation was as low as 2%. For over 50 or 60 years before the global financial crisis, that number was closer to 2.5%, which would mean that nominal Fed funds at neutral would be around 4.5%. So we are at Fed funds of around 5.5% right now, while inflation is substantially above where the Fed wants it to be. Are we sufficiently restrictive? I'd argue it's at least debatable. And I'm not so sure that we're not going to see changes to the Fed's long-term SEPs on where they see Fed funds going forward.
Jim,
sorry.
No, it's all right. Jim, would you agree with that?
Yes, I would agree with that. I mean, people have looked at the 500 basis point rise in interest rates over the last 15 or 16 months and said, wow, that's a lot, and that has to hurt, and that has to have some kind of impact. But what if the vast majority of that rise has just been to keep pace with neutral? And therefore, the amount of restrictiveness that we've put into the system is not that great. And you could see that with the talk that maybe we're going to achieve the soft landing. The economy is not going to have a recession as we move forward. And that's because even though that's been a big rise in interest rates, it's not that far above neutral, and that might give the Fed room to move more should they feel it's necessary in the coming months or year.
25 minutes out from the opening bell, equities at the moment positive by 0.2%. Lots to talk about with the BOJ, still digesting last week's central bank decisions. Mike McKee has more. Morning, Mike.
Morning, John. Well, I thought I'd start this off with a couple of quotes for you, and I think I did it wrong because it might have been more fun if I didn't put the names on them, and you could guess who said what. In September, there could be a further hike of the policy rate or perhaps a pause. We're in an environment of uncertainty and will reassess the situation and our action on a meeting-by-meeting basis. That was, of course, Christine Lagarde in Le Figaro today. But it was just a week ago that you had Jerome Powell saying it is certainly possible we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. Twin sons of different mothers, except one's a daughter and one's a son, but basically the same message for everybody. And you can see what's happened over the last couple of weeks. You've got the terminal rate, the highest rate that the market thinks these people are going to reach, going up, and then flattening out because the volatility has dropped out of it since nobody really knows which way they're going. And for either central bank, it isn't much of a move. Now, to get back to what John started with, the Japanese central bank is in a completely different position. They, on Friday, and you can see what happened, they raised the band for buying and intervening in the 10-year yield curve control, and yields went way up. And then this morning, they breached the 60 basis point level, and the bank stepped in to push them back down again below that. They say they are not getting ready to end yield curve control, but the market doesn't think so, and they're testing them. And the reason this all matters, of course, is if the Japanese yields start rising significantly like the rest of the world, then money will flow back to Japan, out of the U.S., out of Europe, and that will have an impact on markets and rates here. So everybody keeping an eye on the Japanese. They're the ones who are not doing strategic ambiguity now, but the market thinks they are.
Lack of clarity around the thresholds there, Mike. Did you sense it was the pace of the move from Friday or the level of the threshold, 0.6%?
My guess it was a little bit of the pace of the move because they want to tell the markets, don't test us. We're going to come in if you get too far ahead of yourself.
Mike McKee, thank you. Jim Bianco, I want to come to you on this. We still have yield curve control, kinda. There's a target rate with a ceiling of 0.5. At least they've told us it's not going to be a rigid ceiling. They might let it go beyond, but they will come into the market every single day and buy at 1% if they need to. Then they step into the market at 0.6%, Jim, and we're all scratching our heads. What is the policy? What's the policy, Jim?
We don't know what the policy is. You're right that the 0.5% has now become a reference point. It's not become a ceiling, whatever a reference point means versus a ceiling at this point. I think the Bank of Japan is kind of stuck. They've had this yield curve control policy since 2016. We've completely lost the narrative on it. Remember, the target is 0, and then they just keep expanding the band, and the upper end of the band becomes kind of the new target. So that's what I mean by that they've lost the narrative on it. And so they're trying to figure out what to do with it next. And they're also afraid a little bit about letting it go because of the amount of indebtedness that the Japanese economy has, that if the interest rates were to start to really shoot up, it could have a big impact. And just to reiterate something Mike McKee said, too, let's not forget that the Japanese are the largest owner of U.S. treasuries in the world, more than China. And if their rates become competitive with U.S. rates or the rest of the world, and money flows right back into Japan, then you could definitely see it coming out of U.S. treasuries, and that would be a net negative for the U.S. market.
Let's build on that. Sonal, I'd love your thoughts on it. There are vulnerable parts of this bond market with a big presence of Japanese investors. How vulnerable are those parts of fixed income?
I think that, honestly, this is a part of the reason that I have been arguing for a while now that U.S. 10-year yields are on their way up. This is one element of it, but even without the Japanese, and I get it, it's constructive ambiguity, but I totally agree with Mike McKee. It's a lot more to do with the pace of that 10 basis point move rather than the direction. I think they do have inflation. It looks very much like they might sustainably get their inflation target for the first time in almost 4 decades. And so I think we need to be prepared for Japan being the last to the party, but coming to that party, and probably sometime, maybe next year, beginning to think in terms of raising rates. And absolutely, it has an impact on U.S. treasuries, especially if the Fed is not in a position to start cutting. And I don't think it's going to be in a position to start cutting soon. It's going to be into next year before we can even start thinking about rate cuts.
It's taken a long time to get to that party. Sonal, Desai, Jim Bianco, you guys are going to be sticking with us. This quote from Governor Kuroda, I'll give you the date on it in a moment, if you missed this. This is from minutes from a meeting a long time ago. We should avoid deploying our firepower in incremental steps and aim to achieve the target at the earliest possible time. Specifically, I have about 2 years in mind. 2 years in mind to get inflation back to where they wanted it to be, to do all that easing. That quote was from Governor Kuroda of the BOJ back in April 2013, more than 10 years ago. And as Sonal pointed out, we've been doing this over in Japan now for decades, trying to figure it out. You see it in dollar yen this morning, weaker Japanese yen as the BOJ steps back in. Dollar yen at the moment, 142.43. Let's get you some movers going into the opening bell. Here's Abby.
John, let's start with the shares of SoFi, because after a very choppy pre-market morning, we do actually have the stock rising significantly at this point after the online bank raised its revenue guidance for the year, citing benefits from deposit growth and lower funding costs on loans. Right now, up 13%. Palantir also up sharply, up nearly 6%. I suspect this has something to do with tech bull Dan Ives last week initiating on the stock with an outperform rating and a $25 price target, suggesting that more than 20% upside potential is available from here, plus AI being attached to this name. And then finally, to the downside, Ford, Jefferies has cut their view to a hold. They see a worse than expected losses on electric vehicles. It's interesting, into today, the stock up about 20%, the same as the S&P 500. So basically performing as is, but it looks like today Ford is set to take a dip, John.
Abby, thank you. More on that call a little bit later in the programme. Coming up, first into the hiking cycle, first out.
We think the big opportunity right now for the next 6 to 12, 18 months is in emerging market equities and commodities. Emerging markets are going to lead the next cycle in central banks, which is rate cutting, right? We're at the end of the rate hiking cycle in the West.
In EM, the rate cuts are here. That conversation up next.
The signs of deflation are not there in China. What concerns me more is that of a deep recession in China that might have impacts on the stability of the regime, on the stability and constancy of economic policy. The problem with their growth engine is that they've run out of really lucrative investment projects, and that's causing their growth rate to slow down.
It's Carl Weinberg of High Frequency Economics, the latest there on China. Elsewhere, the first to hike, the first to cut. As the Fed and the ECB gear up to hit pause, EM central banks are gearing up to reduce interest rates. Latin America shifting to looser policy, with Chile delivering a 100 basis point cut. Brazil expected to follow later this week. This as China is looking to stimulate its economy by removing consumption restrictions. Equities across emerging markets are threatening to break out. Damien Sasser of Bloomberg Intelligence joins us now. Damien, these were the original front loaders. They got out there first, and we're starting to see the cuts already.
That's exactly right. Well, I mean, it's because their economies are weakening, Jonathan. That's the real story here. It's not so much that, they can cut. And believe me, in Brazil at 13.75%, that's the Selic rate now. They've got plenty of room to cut, but it's the fact that their economies are just not growing. So this is where the rubber meets the road. So I'm not an EM equity guy, but with response to the commodities and EM equities, which are typically late cycle bets, it's interesting to hear some of the other guests talking about how that's going to lead us out of where we are, and it's going to be the beginning of the new cycle. I don't know if I'm so convinced of that, but EM equities certainly, on a valuation perspective, appear relatively cheap to their DM counterparts.
Damien, just how much progress have they made on the inflation story in the places like Chile, where we've had a cut, Brazil, where we're likely to get one later this week?
So Latin America's made a lot of progress. It's Eastern Europe which really concerns me. Hungary's already started the cycle. We're starting to see inflation come off in the periphery. I'm talking Poland, the Czech Republic, but it doesn't seem like those central banks are so willing to cut. In Chile and Brazil, they certainly are. They've gone a long way. And so, yeah, it remains to be seen. My focus is going to be more on the Asian high yielders, Indonesia, India, and the like. They have room to cut, and their economies are weakening pretty significantly also. I mean, and certainly you mentioned China. If China continues to kind of fall off a cliff here, that's not going to be good for the Southeast Asian bloc. And so, yeah, I'm going to be looking at those economies very closely.
Damien, I'm calling the situation in China a shift in posture. It's an easing posture. They're saying the right things. They're going to start to do those things. You're going to see big moves out of that country.
I mean, Jonathan, we've been waiting for Godot for so long, and it really isn't about the supply side. I mean, Jonathan, I'll give you a stat for you. Their fiscal deficit to GDP is actually shrinking. So all the talk about extending restaurant hours, removing restrictions on second car buying, all the things they're doing on the property sector, if they can't still demand then we have a big problem here. So, we're hoping that stimulus, we're hoping that rate cuts are going to do it. But without putting cash in the hands of households, the verdict is still out.
Do you remember when we used to talk about global synchronized growth? Do you remember that? Everything was synchronized. What about now? How unsynchronized is this policy cycle from EM to DM?
And it's all about interest rate parity. It's all about interest rate differentials. It's all about everything we've talked about with the yen and the carry trade. I mean, you look at Brazil, you look at Chile, you look at these double-digit yielding economies, and you say, wow, I can carry so well in them, and especially on a volatility-adjusted basis now with the VIX coming off. So, I can see the value there. I can see the attraction there. But there are some real problems that are facing these economies, and you rightly point out China. China's now a funding currency, right? The China yuan is now used to fund taking risks in places like Brazil. It was the other way around not long ago, and so this is the paradigm we now live in.
Damien, thank you, sir. Back with us for some final thoughts. Sonal Desai, Jim Bianco. Sonal, it wasn't so long ago we were talking about China reopening. That economy was going to do wonders this year and support global growth, particularly in places like Europe. It's the end of July and we're talking about easing. What does that tell you?
Well, I think there was too much expected from China. It's been slower, but I'm probably not quite as pessimistic. I'm not an equities person, but I'm looking at from the fixed income side. I do think precisely because China's running a relatively small fiscal deficit, there is room for them to ease. That's a big deal. And by the way, that's true globally for emerging markets. Not every single one, clearly, but emerging markets in general simply did not loosen their purse strings as much as developed markets did. So there is scope to actually assist on the growth cycle in EM, not just from monetary, but to some extent from fiscal, which DM don't have. So I would say I wouldn't be throwing in the towel on China yet. I still think that as they get a little bit of support off the ground, the rest of Asia stands to benefit from this particularly.
Jim Bianco, do you think the policy mix is more favourable in emerging markets right now?
Well, it is more favorable because, as Damien said, their economies are weakening and they're trying to respond to it, and they're already starting with double-digit interest rates. But of course, when you talk about emerging markets, the biggest one is China, and I'm a bit more pessimistic about China. Just, Jonathan, what you pointed out a minute ago is in January, they did probably the biggest stimulus in the history of China. They ended zero COVID and sent hundreds of millions of people back to work. And that didn't do it. And I don't know if extending restaurant hours and cutting interest rates a little bit is going to really matter at this point if what you did in January did not really get the economy going. And so China is definitely going to lead that emerging market slowdown that we've seen. And I suspect you will continue to see those rates in emerging markets continue to get cut as we go forward.
Jim, are we seeing the early signs in China specifically of the country grappling with a balance sheet recession?
I think we are. I think we're seeing it dealing with a lot of issues, not only with a balance sheet recession. Of course, the property market is still in trouble, but also in trying to figure out where China's going to go next, where they're going to lead, where they're going to follow. They're kind of in a flux and in a transition, and it is showing up in their economic growth.
Big one-week gain on Chinese equities, Jim. You just wonder then how much longer that can last.
Yeah, but you also keep in mind that the big one-week gain has come after many, many months of their stock market struggling. So their stock market is at a much higher volatility level, and it's hard to say whether or not that gain has been driven by some kind of reassessment about their future, or if it was just an oversold bounce.
Under the radar, there's been this rally in commodities as well, looking at Brent crude back to about 86, WTI up to 81. So now, how closely are you looking at that right now, and what kind of signal are you taking away from it?
I think I'm taking away that same signal, which is that everyone anticipated a significant slowdown on the back of developed world hiking, and instead it hasn't happened. And now we're at the cusp of emerging markets beginning to cut and start re-stimulating their economies. So it doesn't surprise me that much that we're seeing crude respond to that growth simply hasn't slowed down the way people were anticipating even a few months ago.
Sonal Desai, Jim Bianco, To both of you, thank you. To set us up for the trading week still ahead, going into payrolls on Friday, 200k the estimate, by the way, and going into earnings on Thursday from Amazon and Apple. At the moment on the S&P 500, about 7 minutes away from the opening bout, equities positive by 0.2%. Coming up in the morning calls and later, Citigroup's Stuart Kaiser making a case for sticking with big tech ahead of those results from Apple and Amazon later on in the week. That conversation up next.